I've got my fingers crossed. Everything is working correctly. And this is my first time recording a podcast in Discord.
Well, I hope it won't be the last time because there were a lot of topics that we wanted to touch in upon, but I think this is a nice program with the topic that we chose for today's episode.
Denne podcasten og innholdet skal ikke anses som investeringsråd. Hensikten med podcasten er å bidra med informasjon om finansmarkedene og selskaper. Podcastvertene er selvlærte hobbyinvestorer og ikke finansielle rådgivere. Informasjonen som gis i podcasten utgjør kun våre personlige meninger. Hvis du legger vekt på noe du har hørt her, gjør du det på egen risiko. Verdipapirer som diskuteres i podcasten skal ikke forstås som en anbefaling til å kjøpe, holde eller selge nevnte verdipapir. Podcastvertene kan være direkte eller indirekte eksponert mot verdipapiret som diskuteres.
So guys, listen up. It's a great privilege to introduce Brian Feroldi as our guest for this week's episode. Brian Feroldi is one of the best and most active teachers, if I may call you that, on FinTwit. He has an impressive 550,000 followers on X and around 80,000 subscribers on YouTube. Brian has invested in stocks for over 20 years. And he's also the author behind the book, Why Does the Stock Market Go Up? So welcome, Brian.
Thank you for the warm introduction. It's a pleasure to be here.
So could you tell us a little about your background and what you got and what got you interested in investing?
Sure. Like many people, I was taught next to nothing about investing growing up. I was vaguely aware that there was something called the stock market. It had something to do with the Dow Jones Industrial Average, and that it went up sometimes and down other times, and that I knew rich people were interested in it. But beyond that, I had extremely limited exposure to the stock market, and that is basically from when I was born all the way up until I graduated from college. And that's really sad because I was actually a business major in college. And despite majoring in business, I was taught next to nothing about what the stock market was or how it worked. When I graduated in 2004, my dad handed me a copy of a book called Rich Dad, Poor Dad by Robert Kiyosaki, which for whatever reason, I devoured. I read that book faster than I'd read basically any other book. It introduced many concepts to me that I'd never heard before, such as you can become wealthy in one generation. The rich think differently about money than the poor and middle class do. The rich use their money to buy assets. Those assets can pay for your lifestyle. These were mind-blowing concepts to me, and I just took to that just kickstarted a love affair with all things related to money. In investing, and specifically the stock market that essentially continues to this day.
Sounds great. How would you describe yourself as an investor, and what would you say is the most important edge we as retail investors have? Going on head on with the institutional investors?
So my investing style has evolved over the last 20 years as I've learned more about investing. I started out as a penny stock trader. You can imagine how well that went. I was effectively doing the exact same thing that many investors are doing today on TikTok and Reddit with GameStop. I was doing that same thing, but 20 years ago, except for it was with penny stocks and the Yahoo Finance discussion boards. So I completely understand why so many people are attracted to that style of investing right out of the gate. From there, I switched tactics and became a dividend investor looking for high yield companies. I knew nothing still about business analysis or how dividends got paid. I just assumed that all dividends were paid all the time, and that proved to be a pretty expensive lesson to learn. And then from there, I gradually shifted to being a growth at a reasonable price investor with an emphasis on the quality of the businesses that exist today. So I now am similar to a previous guest of yours, Peter from Compounding Quality. I try and fill my portfolio with the highest quality companies that I can find and own them for long periods of time. Now to your second question, you asked what possible edge could retail investors like us have over the market, over professional traders. This is something I've thought quite a bit about, and I think we have two huge advantages over professional traders. The first advantage is alignment of incentives. That is such an underappreciated but really powerful tool that individual investors have on our sides. And when I say alignment of incentives, my incentive as an investor is to grow my wealth over the time period that I need it to grow, which for me is measured in years and decades. I am not going to fire myself as a financial advisor if I underperform for a stretch of time. So I only have one master to serve. I only have one person to answer to, and that person is myself. And I want the same thing as my customer, if you will. You cannot say the same thing about professional investors. Professional investors are serving their clients. And sometimes what those clients want or expect or demand of them is different than what the manager is able to deliver. Because of that, that creates a pretty big misalignment of incentives, where fund managers' primary jobs isn't to beat the market, even if they state that is. Their primary job is to gather assets. That's how they make more money. If you hold all other constants equal, a fund managing $1 billion will make 10 times as much money as a fund managing $100 million, which will make 10 times as money as a fund managing $10 million. And that is irrespective of the underlying performance of those funds. So fund managers are incentivized to collect, gather, and keep assets, and they are not truly incentivized to outperform and deliver for their investors. So the misalignment of incentives is a really, really powerful advantage that individual investors have. The second big advantage relates to the first advantage, and that is long-term investors, individual investors, can truly invest for the long term. They can buy and hold and be extremely patient with a stock for a period of years, when that same action, when done by a professional, might be extraordinarily challenging to do, because the people whose money they're managing might get impatient with the performance of an investment and the recent performance of investment, even if that underlying investment the manager believes in. So those two advantages, the ability to invest for the long term and complete alignment of incentives, are the biggest edges that individual investors have.
That's great answers and reflections there. Would you say also that perhaps because we're responsible for our own portfolio, we have to we don't have to stress about having some bad quarters or 2 bad years if the fundamentals are kind of intact? We don't have to sugarcoat the results.
Absolutely. You know, one of my favorite investors to study in the markets, that's actively in the markets right now, is Terry Smith of Fundsmith. He's got a style that I really like and appreciate. And he, at his recent annual shareholder meeting, was in the year before that shareholder meeting, he was buying up Facebook stock or Meta stock very heavily. He was a big-time investor in Facebook, and that was during the time when everybody hated Facebook, and the stock was effectively going straight down. I think peak to trough, that stock lost like 70% of its value, and meanwhile, he continued to buy and add to it. And he said, that he would get questions from his investor base constantly about what is this Meta stock you're buying? Why are you buying Meta? This company is a piece of garbage. Now he has the confidence in himself and the long-term holding period to kind of tune out that noise, given the short-term performance of the stock, and really focus on the long-term fundamentals of Facebook. And that style rewarded him with multi-bag of returns from his return. But you can imagine being a fund manager and literally having your customers, the shareholders are Terry Smith's customers, tell you, why are you buying this piece of garbage? And putting pressure on you to effectively do the wrong thing, which is sell this stock that you think is a buy. Pushing back against that pressure or ignoring that pressure from the very people that you're earning a living from is not something that is easy to do. So I would say that he's one of the few investors out there that is capable and confident enough in his skills that he can do so. But pushing back against that criticism against your portfolio is extremely hard to do. You know, one analogy that I like to use is think of fund managers like politicians. Politicians, if you ask any politician in America, what is your job? They will tell you their job is to represent the constituents in their territory or their geography, to represent them and their interest in Congress or the presidency or wherever in government. But if you actually dig into what's a politician's actual job, their actual job is to get reelected. It's to gather votes. That is the thing that they are incentivized to do and to stay in power. It's very similar for a fund manager. They'll tell you their objective is to make money for their clients and to beat the market and to build wealth, but their actual objective is to gather assets. And because of their actual objective, they are forced in many ways to focus on the short-term performance of their stocks, the short-term performance of their holdings. And it takes great fortitude on behalf of the fund manager to look beyond these short-term incentives and focus on the business.
That is actually a great euphemism you use there regarding fund managers and politicians. I really like that one. And Terry Smith is a huge icon, if I may say, on our StockUp community as well, because he is also the reason why I personally wanted to buy high quality stocks. You look at the return of capital or on capital employed or return on invested capital, and you can see the growth of the company's earnings are kind of growing exponentially because of that factor, you know. So formerly, I just wanted the lowest PE ratio that I could find and think its value, but of course, it's not that easy.
Yeah, if investing was all about finding the lowest PE stocks possible, then computers would have rendered investing moot a long time ago, because it's not hard for anybody to look up what is the lowest PE stock on the market today. So that is why investing is part art, part science. Anybody can look up with tools we have available today the science part, the hard number part, but the art is thinking through the business model and how that relates to the real world and the future of a company. That's where the art comes in.
So, Brian, before we go on to the main topic, people will be curious and will be irritated if we don't ask you what's your top 5 holdings, if you can disclose them.
Sure thing. Let me pull up my portfolio just to make sure I get the most accurate numbers. So, broadly speaking, when it comes to my portfolio, I am a long-term buy and hold investor. So the 5 holdings that I'm about to tell you, the reason that they are top holdings for me is not because I went out of my way to make them my top holdings. The reason they're my top holdings is I bought them many, many years ago, and those companies earned their spot in my portfolio to become a top holding sheerly through capital appreciation. So all of my top holdings are going to be my biggest winners of all time. And these change around based on stock price movements. But as of right now, my number one holding is Mercado Libre. My number two holding is Google. My number three holding is MasterCard. My number four holding is Meta, aka Facebook, and my number five holding is Amazon. In all of those cases, I made my first purchase a minimum of 7 years ago. In Google's case, I've owned that stock for 15 years, and all of those stocks have grown dramatically to become my largest holdings.
That's a strong list there, Brian. We just had an episode, I think, a couple of weeks ago, where we discussed the Dollarama, which is noted in Canada, and Mercado Libre. Mercado Libre is just, it's so amazing looking at the CAGR there, both on top and bottom line. It's out of this world, to be honest.
Yes, it's an extremely impressive company.
So I must say, given the short time we have communicated preparing for this episode, you strike me as quite the perfectionist. And we made an agreement that we should focus on just one topic, even though we wanted to pick your brains on everything. But because of the limit of the time, and to make this podcast episode running for like 4 or 5 hours, we narrowed it down to give the listeners a deep dive in MOAT. And this is one of the most important qualities of a company. Could you walk us through that subject? And we will ask a couple of questions as well regarding MOAT that we want to pick your brains on.
Sure, let's do it. So MOAT. What is a MOAT? A MOAT, the term was famously coined by Warren Buffett, and said simply, it is a sustainable competitive advantage. It is a trait that one business has that allows it to have a durable advantage over the rivals in its same industry. The reason that MOATs are so important, and Warren Buffett harps so heavily on them, is that we live in a capitalistic world. If a company develops a product or a service, introduces that service to the market, and has some success and grows its profits, you can be assured that eventually competition will see those profits being generated. Competition will race in to the market and offer a competing product at a higher quality or a lower price, and they will do everything that they can to steal customers from that business and put downward pressure on that company's profits. Now, if our goal as investors is to buy companies that grow their profits forever and use those profits to reward shareholders, competition is a really, really bad thing for investors. This is why a company having a moat or something innate in that business that pushes back against the forces of competition and against the forces of capitalism is so important, especially towards long-term wealth building. If you look back at just in the last couple of years, there's been many companies that have caught fire. Their products or services have taken off. And those companies actually lacked a moat, and basically as soon as their profits went up, their profits just as soon came crashing down. So a few years ago, for example, I know some investors that were very excited about Fitbit. Fitbit, the wearable technology that tracks all kinds of metrics for yourself. And for a while there, Fitbit's growth looked unbelievable. Its product was extremely popular, but Fitbit had no moat beyond a brand, and its brand wasn't particularly strong. Sooner or later, competition entered in, most notably Apple with their Apple Watch, and that just eviscerated Fitbit's business. You could say the same thing about GoPro. GoPro, once upon a time, was a red hot stock. Beyond the Meat, once upon a time, was a red hot stock. Michael Kors, a fashion designer, once upon a time, a red hot stock. And in each case, if you invested in those businesses, boy, did you lose your shirt, because none of them had built themselves a durable competitive advantage that allowed them to sustain profitability. And shareholders in those companies were drastically, their wealth in those companies was drastically cut due to the forces of capitalism. So with that, there are five primary categories of MOATs that create durable competitive advantages for businesses. So I guess we'll dive into one at a time, then I'll pause and let you ask me any questions that you have about it. So the first source of MOAT is a network effect. A network effect is probably the most powerful MOAT that a company can have, and it's also rare and very hard to develop. A network effect means that as new users sign up for a product or service or platform, those new users create value for existing users, everybody else that's on that network. The simplest example of a network effect is simply the telephone. When Alexander Graham Bell launched the telephone in the 1800s, and there was, let's just say, 2 phones in the world, how useful were those phones? The answer is not very useful. You could pick up the phone and you could call pretty much one other person. So if you wanted to talk to that person, great, over a long distance, but the usefulness of that single phone was very limited. But as more and more people got telephones, that meant that all existing people with telephones could now communicate with more and more people. And as new telephone users got telephones in their house, that created value for all existing telephone users. And that became an unbeatable competitive advantage, and it allowed AT&T at one point to be one of the most valuable companies on earth. And it was actually basically a monopoly that had to be broken up by the government. So that is the idea of a network effect. When I think about network effects today, I would say that there are 4 major categories of network effects that are out there. The first would just be social networks. Facebook, LinkedIn, Twitter. Every time a new user joins those platforms, it creates more content and more connections for all existing users. So why are people still on Facebook today? It's because all of their friends and family are on Facebook today. So that's a very easy competitive network effect to understand. Another type of network effect, a more recent one, is a data network effect. So the more users there are of a product, the more data that company generates, and the company can use that increasing data to make the product or service better, and that leads to a better product or service than the rest of the market can offer. This is the thing that allowed Google to become Google. Google's search technology used the searches that its users were making to make more accurate search results for all existing users. And that is one reason why Google went on to effectively have a monopoly in global search. They captured the most market share, and then they used the network effect to make their search engine by far better than any other search engine that was out there. A third type of network effect relates to marketplaces. Marketplaces are places where buyers and sellers meet to exchange money for goods with each other. There are marketplaces out there like the New York Stock Exchange, where buyers and sellers of stocks come together. There's marketplaces like Etsy and eBay, where buyers and sellers come together to exchange all kinds of home goods with each other, or in Etsy's cases, crafts with each other. There are marketplaces like Airbnb, where home listers go to sell temporary home housing to vacationers and people that want to buy temporary housing. And there's other marketplaces like Market Access, which is a digital bond trader. So marketplaces have natural built-in network effects to them. The last one I'll call out, and then I'll pause for questions, is transport companies. Some companies have networks of transport that allow them to be bigger and more established than other businesses. So DoorDash has built one of the biggest networks of food delivery in the country. Uber has the biggest network of on-demand transportation and taxi services. FedEx has built one of the biggest networks for shipping goods from one part of the world to another. And the network effect provides all of those companies that I mentioned with a competitive advantage in their respective industry.
Yeah, so how come the network effects is such a powerful moat?
The reason that network effect becomes so powerful is that after it reaches a tipping point, there becomes no reason for users of that product or service to switch to an alternative. It effectively, a network effect done the right way, effectively creates a monopoly in its industry, and it becomes nearly impossible for rivals to compete with it. I mean, imagine I said to you, I want to compete with Airbnb, right? Let's start a new place and we're going to compete with Airbnb and we're going to charge less fees and we're going to have a nicer website and whatever. How hard would it be to get users to switch from buying on Airbnb to our service? It'd be nearly impossible. Even if we offered way lower fees, because the number of house listings that we would be able to generate on our own would simply be dramatically lower than what the network that Airbnb has created for itself. And if I had a house and I wanted to rent it, would I list it with us or would I list it with Airbnb? Airbnb has a ready-made pool of buyers on its platform that are looking to buy temporary housing. So Airbnb, despite its high fees, can simply offer something that would be incredibly difficult and incredibly time-consuming for a rival upstart to create. So, for that reason, network effects are self-reinforcing, and if it's a great network effect, it's very durable in time. So, I think that makes it one of the most powerful that's out there.
Yeah, that's very interesting. So, what do you look for to see whether a network actually translates to economic value for the network owner?
That's a great question. The key thing to watch there would be the growth of the network, right? There's typically two sides to the network. In the case of like Airbnb, there's the supply, which is the house sellers and the buyers, and it's the company's job really to balance the incentives for both and grow both exponentially at the same time, which can be very challenging to do. One of my favorite ways to tell if a product or service is creating value, especially when that company is purposely not profitable, they're investing for growth, is simply to keep my eye on the gross margin of the business. If a company's gross margin is stable or even better, rising over time with increasing scale, even if the profits aren't there, that is a sign that the company is maintaining its pricing as its revenue growth is very, very high. Eventually, that gross profit, once the focus doesn't become absolute growth and becomes rewarding shareholders, that gross profit can then be reallocated towards value accreting activities like dividends and buybacks and paying down debt and all that kind of stuff. But one thing anybody can do with any business, especially a growth business, is zero in on the company's gross margin.
Yeah, that's an interesting take. So, yeah, yeah, that's a great answer. I was wondering, okay, investing in growth is a key driver for these networks, but how do you, like when they're in the phase before they're profitable or produces profits, how do you value this stuff?
Valuing companies that don't have profits can be extremely tricky. There are a few ways to do it. When a company is purposely losing money, you can, of course, use very simple valuation metrics that don't use earnings or profit in the denominator. Some of the popular ones that are out there are the price to sales ratio. I personally prefer the price to gross profit ratio as opposed to the price to sales ratio, because that accounts for the gross margin of the business. So that can be one metric that you can look at to see how expensive is this business today, even if it's unprofitable. You could also look at the market cap of the business. If a company looks like it's developing a network effect, and let's just say it has a $5 billion market valuation, and you think it would be reasonable that if that company was successful, that 10 years from now it could have a $50 billion market valuation. If you thought that was achievable, well, that would mean that even if you invested today, if you are right, then you could earn approximately a 10x a return, a little bit less than that to account for any dilution that you might take on. So I would say very simple multiple analysis, just higher up on the income statement, and then some rough back of the envelope total addressable market analysis are really your only ways that you can value businesses when they are purposely losing money.
Yeah, I think that's really important, as you say, that you have to look at the total addressable market to that individual stock, because I know there are many that have tried to replicate how you valued Meta or Facebook during their growth period, but there are very few other businesses like that can achieve the same thing. Thinking just about Twitter in the beginning and Pinterest and all that stuff. They got quite high valuations at one point, but didn't translate.
It's tricky. I mean, there's no doubt that it's very tricky to do so.
Yeah, cool, excellent. So what's the next one?
Yep. So the second major category of MOAT is loosely called switching costs. This is when there is some pain that the customer would have to take on in order to switch from one provider or one business to another. Now that pain could come in many different forms. It could be time. That would be or hassle. It's just a hassle to switch. That pain could be in terms of money or cost. There would be a high dollar amount to exit from that company. It could be in the form of training, where you get used to using one product or service, you get integrated with it, your team is trained on it, and then to switch to an alternative would require retraining of a big group of people. That training switching can be hard. Or finally, on the business side, just sheer risk of business disruption. If you had your business centered around Shopify, for example, Shopify handled your website and your payments and your shipping, and it handles a lot of stuff for small businesses. If you wanted to switch away from Shopify, well, you risk losing sales because your business would be disrupted if the new payment processor didn't work or the new systems weren't set up correctly, and that's just at the small scale, right? You can imagine at the million or billion dollar scale how much pain or loss of money there could be if business systems didn't switch well. So when we dig into the details of switching costs, from the business disruption perspective, companies like Shopify come to mind. Companies like Intuit, which has TurboTax and QuickBooks come to mind, right? Those they offer mission critical software for dealing with your taxes or your office. Companies like Atlassian come to mind, which offer communications and productivity tools for corporations. Another source of switching costs is when a company offers a very highly valued product or service that has a very low price. And the low price is relative to the business. But you can imagine, take a company like Planet Fitness, for example. Planet Fitness, with Planet Fitness, you get access to a gym, right? Unlimited access to a local gym. And what do they charge? Like $10 a month or $12 a month or some very low nominal fee. So many people don't switch away from Planet Fitness because the hassle of switching gyms or turning that off is so is large enough in comparison to the very low price that a company charges. Personally, I don't watch much Netflix at all, but I still pay my Netflix bill because the price for me is fairly low in comparison to the value that the rest of my family gets for using Netflix. The final examples would be the training cost, as mentioned. So this is very common for software companies. If you train on using Autodesk's CAD products or Adobe's Photoshop or Premiere products, or if you are a surgeon and you train on how to use Intuitive Surgical's system or a medical device technology like Abiomed, the training time to learn how to use those systems is quite intensive. So even if an alternative came along that saved you time or saved you money, or there's resistance on part of the customer to switching simply because of the time involved. And switching costs can be also very useful and very powerful. I mean, one thing that I always think to myself is, when's the last time I switched banks? The bank that I have now is, I think I signed up for in like 2004. So I'm on 20 years of dealing with my current bank, not because I'm in love with my bank, but because it's integrated in all my different payment systems. And, my credit card bills are paid from there. My utility bills are paid from there. And if I was to switch banks, all of those automatic systems that I have would just get wiped away, and I would have to reset them up at a new bank. So for me, it's like, why bother with that hassle when just staying with my current bank is so much easier?
Yeah, it's funny you should say that about banks, because that's we had a question about that, because we experience the same in Norway also. And but what I wanted to ask about is, how do you assess regulatory risk in that respect? Because officially here in Norway, the government are trying to make a bank switch easier. So that could be an issue. How do you assess such risks?
Yeah. So I've never heard of a government imposing a rule that would make switching banks easier, but that is an interesting one. If they succeed in doing so, in passing that legislation, you also then have to watch, well, do customers switch? You have to watch customer behavior, because even if the government imposes rules that make it easier, that doesn't mean that customers will go out there and switch. When I think about my my phone, I'm an Apple user. Apple and Android are extremely similar software programs now. Moreover, if you switch from one platform to the other, those companies have systems in place that make it extremely simple to port over your contacts and your mail, and basically make it so that the switching from one platform to another is fairly easy. But the next phone I'm going to buy is going to be an iPhone, is simply because it's what I'm used to. So even if switching away became easier, that doesn't necessarily mean that that I would. But you do bring up a really good point that sometimes, I guess in some corner cases like you have now, those switching costs can be reduced over time due to innovation on the part of businesses, or in your case, regulation.
Yeah, I'm not sure that they are going to succeed in getting it easier. Probably be like the Australian government tried to do it with MasterCard and Visa, but
Right.
yeah, it's gotten worse for the consumers down there. All right, so how what do you need to think about in generally in risks relating to these switching cost things?
Yeah, I mean,
Are we in trouble?
Yep. So you already brought up a really important one, which was that the companies and the marketplace can succeed at lowering switching costs through innovation. I already mentioned that Adobe, Photoshop, for example, and Premiere, Adobe's products have been the gold standard for decades. And it took a long time for people to learn how to use those systems and really get up and running with them. But more recently, we've seen companies like Canva and Figma in particular, come out with web alternatives that are very high quality and in some ways clone the experience of using Photoshop so that it becomes lower barrier to switch away from those existing products to other ones. So you still have to keep an eye on competition, and that's especially true if a company with high switching cost is abusing its market position, if it's annoying its customers, if its customers feel like they are paying too high of a price to use a product or service, and they're actively starting looking for alternatives. Like, for example, if Netflix tomorrow woke up and said, yeah, you're going to be $30 a month instead of $15 a month or whatever it is, I'd be like, all right, they're abusing their position. I'm going to look for alternatives as a customer, or just ditch them all together. So that is absolutely something you need to pay attention to. So yeah, it's just something you need to monitor.
I just wanted to add, one of the largest funds in the world, or the largest fund in the world, is actually the Norwegian Oil Fund. And Nicolai Tangen, which is a known hedge fund, or previous hedge fund manager in Arco Capital in London. He is the manager of the Norwegian oil fund. He said regarding disruption and so on, or regulations, or the switching cost that you referred to, that he liked L'Oreal because the politicians will never regulate that kind of sector, because nobody gives so pardon my French, but nobody gives a shit on on what you're putting on your face. And
Right.
because of there was a huge survey in Europe where people, or girls or women, would never change their brand when they first picked L'Oreal. Everything was a downgrade. So that's kind of a huge moat. Wouldn't you agree?
Oh, for sure. If I'm not familiar with that study, but yeah, if girls seem to be if women seem to be brand loyal to their makeup, and they view everything else as a downgrade from there, absolutely, the cosmetics industry has historically been a great place to earn a return. In the United States, there's a company called Ulta Beauty. There's another one called ELF, ELF. Beauty, and they've been fantastic investments over the last couple of years. So makeup does the makeup and cosmetics does have some very attractive characteristics, including switching costs.
So how do these companies with that have built this strength through switching costs keep their position or strength?
Yep. So it's really about reinforcing and hammering in and making their switching costs even higher over time. So adding in layers of training, adding in services, making it easier for their customers to do what they need to do, increasing the hassle that it would be to switch away from them, and really maximizing the value that they give to customers in exchange for the price that they are charging. So this to me is like the number one thing that every management team should be doing. It's what is your competitive advantage, and what have you done in the last year to strengthen that competitive advantage?
Yeah, that's great. I'm thinking about the Costco in the back of my mind when you say that, like, keep the prices cheap, and then they come back.
Well, yeah, that gets to our third one, our third moat,
Yeah.
which is low cost production. Now, this one, I think when people hear it, what they hear is low prices. That is not what this moat means. This is low cost production. It is the internal cost of the company to produce the product or service, or deliver the product or service to market. So when most people think of low cost production moat, they naturally think of Walmart and they naturally think of Costco simply because those companies charge very low prices for their product or service. Now, those companies do benefit from low-cost production, but the moat that they have is because they can deliver those goods to their customers at a lower internal cost thanks to their huge buying power. So Walmart and Costco can go to their suppliers and they can negotiate extremely favorable terms due to their huge buying power, and they can take those cost savings for their huge buying power, deliver it to their customers, pass on those savings to their customers, and still make a good profit. So again, to get back to us trying to compete with them, imagine that we tried to open up a warehouse to compete with Costco. Even if we could get these same suppliers to work with us, there's no way they would give us the same pricing that they give to Costco, simply because we couldn't promise them the same volume that Costco can. So low cost production, internal cost to deliver a product or service. And this can come from economies of scale, huge buying power like McDonald's has, like IKEA has in furniture, like Walmart has in general retail. This could also come from physical location. The location that you have is beneficially located when compared to others. So this is something that waste management companies have, such as Waste Management in the United States. They own dumps all over the United States that are close to city centers. And since garbage is a high weight, low value product or service, Waste Management can sell you garbage services lower price than just a mom and pop store, because they simply own the locations. Similar for theme park operators like Six Flags or Disney. The physical location of their parks gives them a competitive advantage. The final low-cost production would just be the infrastructure that a company has. So Amazon has built out a distribution network across the world at this point, but particularly strong in the United States, that lets them deliver products or services from Amazon warehouses to customers at a lower price, simply because of how closely they located they are to customers than competitors can. The same thing is true of Coupang in South Korea, JD.com in China. So they have an internal cost advantage, and they can use those costs to undercut competitors on the market and still make a profit.
Yeah.
Great. So
that makes sense.
Yep. If there's no question about that, no problem. We'll move right on to the fourth source of moat, which is an intangible asset. So intangible, for those that
could you just have one question about the cost reduction? Sorry.
Sure.
So one thing I've been thinking a lot about, and that is how should we go about thinking assessing the lifespan of the production asset, or the asset that gives you the low cost advantage?
Oh, absolutely. With everything, you have to think about the lifespan of it, and this gets back to the Warren Buffett quote, like how wide is the moat, and equally important, how durable is the moat, how long lasting is the moat. So for right now, let's take Amazon as an example. Amazon's infrastructure that is built across the world, and it's still building across the world, gives it a long-lasting competitive advantage, a long-lasting moat. But should some technology come out that allows us to buy 3D print our goods at home, or some distribution method that makes that infrastructure obsolete for some reason, well, that would mean that Amazon's moat was permanently impaired. The same way that the internet and what Amazon has done has disrupted so many department stores. Department stores used to have very strong moats. They had great real estate. They had great footprints. They were in popular areas that consumers like to shop. And then along came the internet, which took all of the conveniences of mall shopping and brought it to your house. So that was a technological disruption that essentially took the a big moat that the mall anchors had and eliminated it. So it's absolutely technology and disruption is a real threat to wide moat businesses today, because they can render those moats that they've built up over a period of decades obsolete. So it's absolutely something that investors need to think about.
Okay, great answer. We can move on to the next one.
Yep. So for moat category number 4, I'll do 4 and 5 together. They're fairly short. Would be intangible assets. So what does intangible mean? Intangible means something that has value that you can't physically touch. An example would be a brand name. So if I say Apple, or if I say Tiffany's, or if I say Chipotle, those names elicit a thought in millions of consumers, and they convey quality, in all 3 cases, quality to consumers. Those companies, Apple's, Tiffany's, Chipotle, they can charge a premium price for their products or services simply because consumers like and trust those brand names and are willing to pay more for those products or services because they like those brands. So brand is an example of an intangible asset. You can't touch the name Apple, but it has value. Other types of intangible assets include patents. So pharmaceutical companies develop compounds, they patent those compounds, and they make drugs from those compounds, and they can use those patents to protect their profit streams for many, many years to come. Another form of patent would be a government license. There are some industries where the government has to issue you a license to become a seller of that service. This includes utilities. This includes casinos. This includes bond ratings, energy and oil drillers, for example. In many cases, those companies need a license from the government in order to operate and compete in that market. So those in those cases, those are intangible assets, and those intangible assets allow those companies to build themselves a moat. The last category, I think, is a newer one, and it's something that I was unfamiliar with, but I think it's actually a very overlooked moat, and that is called counter positioning. So this is the 5th and last moat. Counter positioning is when a upstart creates a business model that disrupts an existing incumbent, and the incumbent resists adopting that same business model because to do so, they would have to forego revenue. Let me give you an example, because examples are really helpful here. In the United States, for decades, the home video market was dominated by Blockbuster. Blockbuster's business model was set up retail stores in convenient locations, rent movies on a one-off basis, and then make most of your money through late fees. So customers would drop off the movie late. They would get charged a couple extra dollars for dropping a movie off late, and that was the business model. Well, along came Netflix, and Netflix was renting the exact same product, movies. The product was indistinguishable for both companies. However, Netflix chose to do so in a differentiated way. Netflix chose to allow you to have the movies delivered to your house, and you would pay a monthly subscription for those movies. So Blockbuster was certainly aware of Netflix's business model, but for Blockbuster to copy Netflix, they would have to blow up their business model. They would have to close down stores. They would have to stop charging late fees. They would have to shift to mailing customers DVDs through the mail, and it would hugely impact the company's revenue in the short term. If the company was to do that, the management team would be fired. Profits would disappear. The share price would tank. There would be revolt on behalf of the board of directors, and it would just be unbelievably disruptive for the company to go through that transition. So Netflix had a counter positioning moat when compared to the incumbent Blockbuster. Amazon had a counter positioning moat when compared to Walmart and department stores when it first launched. So this is why startup companies, newer, younger companies with vastly fewer resources can actually have a competitive advantage, a moat, when compared to incumbents if they use and develop a counter positioning moat.
Yeah, I think this is a really interesting moat category. Seems like if you have a speedy and powerful disruption, you can build up a really good advantage. But with respect to how long such moat can last, like now the tables have turned. Netflix is the dominant leader, and now they have received fierce competition. What do Netflix have to do to keep their position now?
Yeah, so this is what's interesting about the business, the life cycle of a business. If you imagine there's a startup phase, there's an infancy phase, there's a high growth phase, there's a profit phase, there's a maturity phase, and there's a decline phase. If you can just picture that cycle and what happens to a company's revenue and profits kind of in each of those phases, what moat a company has and focuses on should be impacted by which stage of the business growth cycle they are in. So if we think about Netflix, for example, what moat did Netflix have when it was a startup? It had the counter positioning moat working for it. And it was able to use that counter positioning moat for over a decade to go from being an also-ran to being the most valuable DVD rental company in the market. And as the company grew, it started to develop its second moat. And Netflix's second moat was low-cost production. As it set up these DVD distribution centers across the United States, it could deliver DVDs to customers at a lower internal cost than other companies could do so. And then as it continued to ride that wave higher, eventually Netflix made the hard decision to blow up its business model, its low cost production business model in favor of going all in on streaming. And the company shifted its moat from being all about low cost production to being primarily focused on intangible assets. Namely, the company's brand name, Netflix, has since become synonymous with high quality TV. At the same time, it started to develop switching costs by offering a very high value service in exchange for a very low price. So if you just track Netflix is a company from 1997, from when it was started, to 2024, which is today. Its primary moat has actually changed and evolved over time. And now the company's primary moat is brand and switching costs. So its management team should be focused above all on brand and switching costs as opposed to its other form of moat.
Yeah, that's really interesting. Seems like the management has done a great job to evolve the business. I'm also thinking about Apple. Like they they have evolved quite a bit since the start.
Absolutely. Yep. Apple's another great example of companies that has evolved its business model. You know, when we talk about brand is a very hard moat to develop. and it takes years upon years for a company's brand name to become synonymous with quality or a product or service. So a brand name is something that is pretty much not exclusively, but very commonly the moat that is in mature, large, very profitable businesses. So you and I couldn't, again, start a brand new company today and have our primary moat be brand, because there's no value associated with the brand. Brand is built up over a period of time. Think of like brand like a company's reputation, right? It takes a long time to build up a reputation. Same story for brand.
Yeah. So, with respect to your brands, but what do you typically look for to see whether the business takes care of their brand equity?
Yeah, that's a great question. So it depends on the industry that the company is in. But one thing that can absolutely kill a brand is going down market in order to grow the company's revenue, effectively diluting or sacrificing the brand in order to capture revenue. Michael Kors, I talked about them previously. Michael Kors, once upon a time, was seen as a very prestigious brand, a very luxurious brand, a brand that people that were fashionable wanted to become associated with them. And when they had that brand going for them, they could charge premium prices for their products, and they would earn very good returns because they could charge high prices. Well, when Michael Kors came public, it now had to feed Wall Street's growth. And in a way to chase growth, Michael Kors' management team started to allow its brands to appear in discount stores. So you could buy Michael Kors' products in knockoff or third tier stores at low prices. So all of a sudden, because consumers saw the price of Michael Kors products drop so precipitously, that killed the allure of the brand. It diluted the brand, and it certainly juiced the company's revenue and profits in the short term, but it was sacrificing the allure of the brand in the long term. This is something that Tiffany's has done well for, well over a century now. Tiffany does not offer sales on their products or services. Tiffany offers very, very high prices, and if you don't want to pay them, then they're fine with it, right? They won't sell to you at a discount, because they are heavily focused on maintaining the brand that they have built up for a long period of time. So if you see a brand that is going down market, and brand is the primary moat for the company, that is a sure tell sign that the moat is being eroded.
Yeah, yeah, I agree. That's a really good point. So we have a few more questions. This has been excellent, Brian. We learned tons. So is for you personally, is one or more identifiable modes a requirement in your investment framework?
So I have a checklist that I use, and my checklist has a 100-point scoring system. So the best you can do on my checklist is 100 points. Of those 100 points, I have 20 of them devoted to the moat of the business. So it's one of my most important categories that I look for. Now, I don't necessarily care about the source of a moat. I do care about that a company has a moat, and more importantly of all, is the direction that the moat is heading in. I want to see signs that a company has a moat, or at least has the potential to develop a moat, and it is making moves to widen and strengthen that moat over time through increased scale, or offering more products and services, or making it harder for customers to switch away, whatever it is. But for me, if I don't think a company has a moat, like let's say it scored a 0 on that part of my checklist, it would effectively render the company uninvestable, according to my framework. That's how important a moat is to me.
Yeah, that sounds great. So if people want to learn more about modes and the finer details, Do you have any recommendations for a reading a book?
Sure. Two books come to mind. The first book would be The Little Book That Builds Wealth by Pat Dorsey. It's a very short book. It's a very short read, but Pat Dorsey is someone I've learned a lot from. He was the former chief investment officer at Morningstar, and he's taught me quite a bit about moats. The second book would be 100 Baggers by Christopher Mayer. That's a study of stocks that went up 100 times in value during their run as a public company. He also talks about moats and the moat sources in there. So two great resources to look at.
So, Brian, listen, it's been really, really great having you on board. And just to conclude this episode, what company would you say have the greatest moat if you could only choose one?
Boy, that's a great question. The biggest moat that I've seen, boy, there's a lot of companies out there with some pretty good moats, and no moat is unassailable forever. But when I look over my top holdings, boy, it's hard for me to find a way. It's hard for me to believe that Amazon's moat is going to be disrupted anytime soon, given their distribution network, given that they have switching costs with the apps that they've built and the hardware technology that they've incorporated in people's lives, with how easy it is to buy from Amazon, the fact that you know that you're getting the lowest prices, and in most cases, the delivery is same day or next day. I would say that Amazon's moat of all the companies I've owned would probably be the most durable, but even Bezos himself has admitted that, one day Amazon will be disrupted, and one day Amazon will fail. But I don't see anything that threatens that moat anytime soon.
Kenneth was actually like 20 minutes ago guessing that you would say Amazon. So that's really great. I
Well,
kind
good
of
guess.
yeah. We had an idea. I actually thought you would say MasterCard
Mhm.
because
I debated it. MasterCard, absolutely. The only wild card I would throw out there with MasterCard would be cryptocurrencies. I have no idea how legitimate of a threat that they are, but it is possible. I don't know how to place odds against that, but it is possible that cryptocurrencies could be a technology that's developed that could disrupt MasterCard. I don't see that happening anytime soon, and I haven't seen signs of that yet, but it is possible.
So
Yeah.
now you're touching into a topic that I just I have to ask when you first when you are here with us, and the first question would be regarding that kind of disruption. Do you think are you kind of bullish on Bitcoin or not? Because it's kind of a bipolar stance in the community of pros and cons regarding cryptocurrencies.
Yep. I know enough about cryptocurrencies to know that I don't know enough about cryptocurrencies, and I understand why people are bullish on it. One of my problems, or one of my biases as a human, is I've grown up in the United States, so I only know and experience spending the currency of the United States, which is the U.S. dollar, which is one of the the reserve currency of the world. So for me personally, the idea of using a cryptocurrency does not hold a lot of appeal. However, I've never lived in a country that has experienced runaway inflation. I've never lived in a country that has, huge challenges with electronically or dealing with huge debasements of their currency, and billions of people around the world do live in such environments. And if your mindset comes from those environments, and what you know is massive inflation, massive currency devaluation, pricing power getting demolished, and huge cross-border transactions. For those people, the volatility of Bitcoin looks like nothing in comparison to the actual currency that they earn and spend in their home country. So for those people, I do see a utility, or at least the belief in a digital currency to actually be more appealing to them than their home currency. So for those people, I do see a use case out there that could make Bitcoin a better store of value than their own local currency. If you live in a stable country like we do, with relatively stable currencies, we don't see those same problems. But there are billions of people out there that do. So I have a very, very, very small part of my portfolio devoted to Bitcoin. It is well under 1%. And I don't know how to handicap it. But if somebody tells me they invest in Bitcoin, I understand why. If somebody tells me I don't invest in Bitcoin, I understand it. I understand why. But I will say the people that have believed in Bitcoin since its founding have done awfully well for themselves as investors. So skeptics, people that have been skeptical of Bitcoin have sounded smart for a decade, and people that have bought and held Bitcoin have gotten rich over the last decade. So if I had to be in one of those two camps, I know which one I'd want to be in.
Ladies and gentlemen, Brian Feroldi. Thank you so much. The last bit there, I think that's probably one of the best sequences we've had in StockUp history, because I have to add the Norwegian currency is quite small, and we have been devalued against the dollar. Roughly 30% since 2021.
Wow.
So Bitcoin is it's pretty huge here. So it's kind of giving me bubble vibes, but I'm not gonna go into that. But I think your answer here will be quite popular. It's kind of like the political ambassador, you know?
Yeah.
So
Believe me, I've been aware of Bitcoin since like 2014, and I haven't got it. It doesn't produce cash flow, so it is a very hard asset to value. It is very much a belief thing, but then again, all currencies are at the end of the day based on belief. So yeah, it's a very, very tricky thing, and I understand why people have huge disparaging beliefs on it.
yeah, I do so too, just to be just to notify people. I believe I completely stand behind your assessment there, because I always told myself, invest in companies like Coca-Cola, like Pepsi, like Walmart, like Broadcom, or these giants or behemoths that kind of drives the inflation. That's my hedge and my knowledge, my kind of know what you own. And I don't know cryptocurrencies enough to hold on to that currency if that falls 50%. But if Coca-Cola falls 50%, I'm gonna buy more.
There you go.
So that was my kind of 2 cents there, Brian. Lastly, to round up this episode, what would you like it to be called?
Fantastic moats and where to find them.
Yeah, that's good. That's good.
Yeah, that's really good. We completely agree. I hope, Brian, I know you're a busy guy and so on. I really hope that we made it worth your while.
Yeah, thank you. It was a pleasure to be here. And if anything else, I learned that Discord is a podcast recorder too. So that's you expanded my tech stack.
Super. Listen, guys, we recommend everybody to follow Brian Feroldi on X, and also to have a look at his videos on YouTube as well, and also have a read on his book as well. I think we will link it as well on our Discord. You wrote it 2 years ago, Brian?
Yeah, it published 2 years ago. Yes,
Yeah.
2022. Yep, it's a primer on what the stock market is and how it works, explained in extremely simple terms.
Yeah, that's I saw a lot of good reviews on that one. So and I've read some part of it. I haven't had the pleasure of reading that book, but I'm gonna put it on my bucket list with a lot of other books as well. So Brian, thank you so much, and we wish you all the best, and we hope that you will return to StockUp podcast in the near future as well.
Sounds like a plan. Thank you for having me.
My pleasure.
Thank you very much, Brian. Have a
Bye,
nice
everyone.
evening.
Bye.